Hello, good morning. Welcome to Brazilian Transfer Pricing Overhaul Preliminary Reactions, organized by Campos Melo Advogados and DLA Piper. My name is Alex Jorge. I'm a tax partner in the Campos Melo office. I'm also the co-head of the Brazilian tax practice. I'm also co-head of the practice group leader of the Latin America tax practice at DLA Piper. It's a pleasure to welcome you here. This event is being recorded, is being conducted in English, and you could have access to the materials we are going to share here after our meeting. And just to tell you that we have a Q&A box at the bottom of the screen that you can send us questions. We're going to try to answer the questions at the end of this presentation, but if it's not possible, we'll come back to you individually with our comments. With that, I would like to introduce our panelists. Randall Fox is the head of the International Transfer Pricing Practice at DLA Piper. He sits in London, United Kingdom. Randall is was formerly with the IRS in the United States and also with the World Bank. He's an economist and has vast experience with transfer pricing, particularly with the OECD and the US framework, but he has also advised Brazilian clients, both in the context of inbound and outbound transactions, including analysis for fixed margins, but also helping companies prepare for new rules as we're going to discuss during this meeting. Welcome, Randall.
Thanks, Alex.
We also have Shee Boon is with DLA Piper. He's a consultant, international tax and transfer pricing. And Shee Boon was formerly with the OECD. So he's very knowledgeable about the OECD arm's length principle and framework. And it is a pleasure to have you here, Shee Boon.
Thank you, Alex. Thanks for the invitation.
Sure. We also have Victor Kampel. Victor is a tax partner with Campos Melo, based in São Paulo. And Victor has been advising clients in international tax and transfer pricing as well. And last but not least, we have Laura Kurth. Laura is a senior associate in the Campos Melo tax group practice. And thank you for being here today, Laura.
Thank you, Alex.
Okay. So this topic is very relevant, and we wanted to, as the title says, to provide you with our preliminary reactions, since the Brazilian tax authorities have officially announced that Brazil will adopt the arm's length principle. So with that, I would like to turn to Victor, who will take us through the agenda and have our initial remarks before we start having the comments from our international panelists.
Thank you, Alex. So the purpose and the goal of this webinar is just to have an informal conversation with Randall and Shee Boon, trying to extract the most of their experience with the OECD rules and what would be the challenges that the Brazilian companies are going to have to face once these new TP system is in effect in Brazil. So we think that Brazilian companies are going to have to do a lot of work to be able to adopt those new arm's length principle, the standards, and hopefully here we can give you guys a glimpse of what we're going to have to do. So in our agenda, we're going to give you guys a little bit of project overview about what was introduced by the latest meeting, during the latest meeting between the Brazilian representatives and the OECD, some guidance on the arm's length principle and what does it mean for the Brazilian companies, the arm's length principle and transfer pricing methods. So we're going to touch base on what are the methods that are not currently embraced by the Brazilian legislation. And we're going to spend a little bit more time on the specific types of transactions based on the general principles. So we're going to break down a little bit the list that the tax authorities gave us during the latest meeting, so we can discuss what are the challenges for each type of transaction. Then we're going to spend some time talking about TP documentation, country by country, master file, local file. maybe some of you are not that knowledgeable about, because Brazilian legislation does not require you to prepare these documents. And then lastly, we're going to talk about tax certainty and the APAs, the maps, and all those things that are going to come along with the TP overhaul. At the end, if we have time, and we're sure we're going to have plenty of time, we can open up a box and a discussion for the Q&A that you guys want to ask us. So to start with the project overview, as you guys know, on April 13, we had another meeting where a more inclusive or more detailed information was presented by the tax authorities and the representatives of the OECD. So having said that, I would like to invite Laura to talk a little bit about the project overview.
Thank you, Victor. So currently, Brazil does not follow the arm's length principle. Our system is based on predetermined profit margins, which is intended to be simpler and more practical to implement, but it is not aligned with the OECD standards, as Victor mentioned. So this movement to change Brazilian transfer pricing rules started in 2017, when Brazil expressed its interest in the process of joining the OECD. And in the year following, Brazil and the OECD launched a project to analyze the differences and similarities between Brazil and the OECD system. And the result of this analysis was that they identified a number of issues resulting from gaps and divergences in the Brazilian transfer pricing framework. And although they have recognized that the Brazilian approach have some strengths in terms of ease compliance and ease administration, their main concern was that the existing divergences between systems were affecting the main goals of transfer pricing rules, which are actually securing appropriate tax base in each jurisdiction, and of course, avoiding double taxation. So in the event that Victor mentioned that was held by the Brazilian government and the OECD last month, they proposed a list of changes for a full alignment of the Brazilian TP system to the OECD system. And as we will see in more details in the next slides, the intention of Brazil is that they will adopt the arm's length principle. They will introduce all the OECD methods, the comparability analysis, which means that we will not have our fixed margins anymore. And they are proposing provisions on specific transactions involving, for example, intangibles, which lacks in Brazil today. They are also concerned with tax certainty, so they intend to design safe harbors. And the motivations for policy change are to foster investment into Brazil, to prevent double taxation, increase tax certainty from an international perspective, and ease Brazil accession to the OECD. And indirectly, because of the new US foreign tax credit regulations, we can also say that the alignment of the Brazilian transfer pricing rules with the OECD standard would ease US FTC worry. It would be at least one step towards meeting the conditions now required by the US to allow foreign tax credit. So these proposed changes for a new transfer pricing system for Brazil are very exciting news. And although the Brazilian government has not given an estimated date for this to be implemented, we know that they are already engaging stakeholders, having meetings with small groups and of different economic sectors to discuss the project. And the intention is to send a bill to the Congress next year. And now I will pass it on to my colleagues who will provide a practical view of the adoption of the changes that are being proposed.
Thank you, Laura. So during the meeting with the OECD, they introduced a couple comments on the ELP, which is going to be the anchor of a new Brazilian transfer pricing system. That means that Brazil is not going to rely or should not rely anymore on fixed margins, except in very limited cases, but should rely on comparability factors. And we're going to have to take into account contractual terms, functions, assets, risk, characteristics of the property or services being rendered, economic circumstances of parties, and marketed and business strategies. Having said that, I would like to ask Randall and Shee Boon to chime in and talk a little bit more about what does the LP mean in practice.
Thanks, Victor. I think, let me pick up on these functions, assets, and risks that you mentioned. So, because I think one of the things about following OECD guidelines is that it is going to be sort of be driven by factual pattern of your business. Because when we apply comparability guidelines in the OECD, it usually comes back to sort of what is your business doing in terms of what kind of functions, what kind of assets, and what kind of risks are associated with that business. And then what comparability standards require you to do is to, having had that understanding, to go out and find comparable entities and then look at their sort of arm's length remuneration. And based on that kind of comparability standard, to determine what kind of remuneration is appropriate for this particular entity that we are dealing with. And in that context, actually also then, when we are looking at OECD guidance, the end state, the end result of what kind of remuneration you should give to a particular entity based on the functions, assets, and risks associated with that entity is a much broader spectrum of remuneration. So when you look at entities, for example, that are really very high function, including sort of things like entities that have intangibles, they can be remunerated for these intangible related returns, either sort of based on a kind of a profit sharing methodology, or they could be sort of remunerated based on royalty types of return by sort of benchmarking what happened if you are able to license out this kind of intangibles, and what sort of royalty return you would expect, right? There is, of course, also sort of a lot of entities that you may be able to justify that, you know, because of the functional profile, they are performing relatively routine functions, and therefore they can earn sort of routine returns, either based on cost plus or resale minus or the equivalent TNMM types of returns. But in OECD methodology, there is this other aspect where, you know, some of these routine returns may be required to be compensated for that additional aspect. And this is what I would call the sort of a routine plus returns that are relatively new. It's found in essence in the post-BEPS OECD guidelines, where certain entities, even though they perform routine returns, they operate in environments that are a little bit more special. For example, because they have location savings that can be attributed to that entity, and therefore that would justify kind of a routine plus sort of returns. And then finally, there are these other groups of entities where what I would say sort of substance poor entities. So they don't perform a lot of these functional activities, but they do provide funding. And then some of these funding are actually actively managed. So for these kind of entities, you could sort of see a kind of a risk-adjusted returns. And then there's another type of entity where there is purely sort of substance poor, providing funding, but it's what I would say a kind of a dumb cash box. Then it's a kind of entity that can be sort of entitled to a risk-free return. So when we step back from sort of what that means in practice when you adopt OECD guidelines, then we are looking at kind of a broader range of remuneration spectrum that an entity can earn based on sort of function, assets, and risk that they perform. And so that is going to be compared to what you have right now, which is kind of a little bit more based around fixed margin, there's going to be a lot more uncertainty around where you want in terms of how you implement your TP policy and remuneration for each entity. And then obviously when you involve tax authorities on both sides of the transaction, not just in Brazil, but also in the other countries, then there will be more room for disputes as well, right? And that I think is some of the sort of more immediate implications that came to mind. Randall?
Yeah, if we think about, I mean, the big shift from the current Brazil rules to this, it really is around comparability for me, because it involves, and what we mean by that is really looking at how does the operations of the company within the transaction you're looking at on both sides of the transaction compare to what third parties are doing. And these comparability factors are what you really are looking at. And so, you know, if you think of it's more than just about being just a manufacturer or just a distributor, for example, but actually what are they doing? What are their functions? Are they actually engaged in something more value driving for the business, or is it more routine? Do they have additional assets? Are they taking on additional risks? And you typically expect the more functions, assets, and risks that you have, the greater profitability you would expect to have achieved as a result of that as well, just as you would see in you know, between parties at arm's length. And so, you know, once you have a good understanding of that, it's really about, you know, what sort of data is out there and available. And, you know, we'll talk about data in a minute, but it just comes down to, for most of the methods, comparing it to, you know, the intergroup controlled transaction within a multinational group to that of, you know, what's happening with third parties. And you can already see, like Boon said at the very end here, how, you know, this can be very subjective. It's not black and white, like maybe more along the lines of the rules are currently. There's a lot of subjectivity to it, and there's you know, sometimes a wide range of what can be considered arm's length, and the OECD system is not only the basis for domestic law, pretty much, you know, worldwide, at least with the foundation of the arm's length principle. There's always some trimming around the edges, but it's also the basis for resolving disputes through the treaties, which we'll talk about later as well. So, you know, it genuinely is a global standard. It goes well beyond just the OECD countries themselves. And so I think if Brazil adopts this, it's really a fundamental change for international tax with Brazil. So.
And Randall, if I may, you touched upon the comparability, right, of the non-related party transactions. And one question that comes to mind is, how do we do this comparability? What are the sources of a comparability that economists like yourself rely upon, and whether, you know, this can be done outside the Brazilian context? For example, could we use comparability between a US and a UK entity, or it would need to be necessarily between a Brazilian entity and a foreign entity, for example?
Yeah, I mean, the way transfer pricing analysis is done is first really understanding what's happening in the business you're looking at. And so a lot of times we'll do fact-finding interviews with people in the business, not necessarily just the tax people within the companies, but within the business, to really understand the functions, assets, and risks, and who's actually controlling risk, despite, you know, what the contractual terms might say in the agreement. You know, once you have a good understanding of that, then you can go and look for sources of data out there in the market, and that could be between third parties, like you said, Alex, between other countries or elsewhere, if you can demonstrate that is actually comparable to the transaction you're looking at. So, I mean, one of the comparability factors is economic circumstances, and so that, you know, that could mean different countries as well. And if you say that, you know, the data that you have is not comparable because it's in a different country or something, or it is comparable because it's in a different country, you have to make that that connection economically, that either it is comparable or it is not. And so it's a, you know, like I said, it's a bit of gray area and judgment call in doing so. And it has its foundation in economic theory as to whether that data would be considered comparable or not. And we'll talk about the different methods in a minute in terms of what we could look at. Sometimes it's internal data within the company. They may have transactions with third parties, and sometimes you're looking at third parties altogether. So, but the key is that the data that you want to use ideally is data involving transactions or profits, or we'll speak about in a moment, but that is reliant on third-party transactions to determine that. So,
thank you, Randall. So if I could summarize, I think what you're saying that the analysis becomes a job for economists, and we will depart from the current model, which is basically a formulary approach that mostly accountants do in Brazil, to more relying on the economic principles and comparability analysis, right?
Yeah, I mean, if you look at the transfer pricing industry globally, it's very multidisciplinary, but at its core, it is about economics, and so it does tend to attract quite a lot of economists, and it's definitely not an accounting exercise, that's for sure. When you're digging into the business and comparability, it really comes down to applying economic concepts, that's for sure. But worldwide there are lawyers, there are accountants that do it, but it is much more involved analysis than typical accounting. So.
Well, so Randall, taking advantage that you mentioned the methods and the use of databases, we can just go ahead and talk a little bit more about how the use of the databases and how they relate to the new methods that we're going to be seeing, such as the TNMM and the transactional profit split method. Maybe Shee can chime in and talk a little bit about these methods, because these are new for us. These rely solely on comparability, and we would like to understand a little bit more about the methods and what we do for valuation of intangibles, and a little bit more. Just walk us through what's your understanding and what have you been doing in the transfer pricing world regarding the new methods.
Yeah, with respect to the 5 methods, so probably the transactional net margin method is what people would be most familiar with. It is considered a one-sided method. It looks at the profitability of one entity and comparing that to third parties, which are doing similar functions, assets, and have similar assets and managing similar risks. And so there are databases out there which have data with respect to profitability of public or even private companies if you're using a European database. And it's a matter of making a connection with the company that you're looking at and the companies that are in those databases and saying they should be earning X%. As opposed to fixed margin, they should be earning this based on X number of comparables. And we think these companies are actually comparable, and that essentially forms a range. Now, that is only one of the methods. The OECD has 5 methods. And sometimes they use, like I said, internal data, like the comparable uncontrolled price method, which could be internal or external data. And that looks at actually data on prices charged between third parties, most often used for licensing transactions, but actually it could be, if a company is selling a product to a third party and we can make the case that meets a comparability threshold under the 5 factors, maybe that data could be used for the controlled transaction that you're looking at. Other transactions which are not one-sided, like a profit split, which would mainly rely on internal data, and you'd only be using that in a case where both sides are creating significant intangibles and bringing something more to the table than just a routine function. Other methods for manufacturing, such as cost plus method, looking at what companies typically earn for routine manufacturing, or a resale price method for distributors in terms of what sort of margins they earn on buying and then reselling goods to customers. So essentially those are the 5 methods, but a lot of times companies and advisors will jump to that transactional net margin method, whether it, again, it's a judgment call about what method you use as well. So there's no real formula to say what method you should use. It comes down to, what data you have available and which one really makes the most sense from a comparability standpoint. Shee-Boon, do you want to jump in on that?
Yeah, I think maybe just an observation around the controversy risk surrounding these methods. It's really I think the international experience in this space generally suggests that because a lot of the time we do end up using TNMM, which is one-sided method. And so you essentially say, okay, one of the entities is the simplest entity. And so you benchmark that entity, you give it a return. But overall, once you go through that exercise, generally the one-sided method gives a return that is relatively modest to that entity. And countries hosting these entities where you kind of apply one-sided method to it generally are starting to realize that this remuneration may not represent a very significant share of the global profits of the transaction. And this kind of dissatisfaction is exhibiting itself a little bit through challenges around the use of this TNMM methodology to remunerate entities in certain countries, right? And so we're sort of, I think, seeing that the use of one-sided methods are kind of increasingly being challenged because countries are realizing that when you do cost plus or resale minus based on TNMM methodology, you go through all these exercises and you find comparables. At the end of the day, it doesn't really move the needle by a lot when it comes to sort of sharing of the profits that are generated by multinational groups. And it can have subsequent consequences. So I think when you apply this methodology, it's useful to just keep that in mind, that it may not be the end of it. Like you might say you prove it and you document it and everything is all consistent with arm's length. It's always sort of potentially subject to challenge.
Yeah, just to shed some further light on that, if a tax authority comes in and looks at that one-sided method where they're provided a 3 to 5% margin for distribution, let's say, and it's one thing to adjust the comparables and get from 3 to 5% to 6 to 7%, like Shee-Boon said. It's a completely different assessment and audit when the tax authority asks for the financial statements of the company on the other side, looks to apply a profit split when the other side, more often than not can be a very profitable company. And, it has more substantial functions, assets, and risks than a local distributor, just as an example. And so that becomes a very contentious audit, which can be very, very expensive, let's say, from an assessment standpoint and, in dealing with that. And so there are varying levels of controversy that you can have within transfer pricing, given the judgment calls that are needed both on, method selection and how that is applied. So.
Perfect. And how does the choice of method work in the arm's length world, in the OECD world? Because here in Brazil, we can elect the most beneficial method, but it seems that this is not usually the case.
Yeah, it really just comes down to what data is available to you. So, and what the transaction is. Obviously, if you can apply what we call the CUP method, comparable uncontrolled price, and your circumstances are similar enough to meet all the comparability thresholds, that's generally what you should apply. But it's pretty rare to have such a perfect transaction. So if you're selling, for instance, products between related parties, and you also sell that same exact product to a third party, and all the circumstances associated with those two transactions are such that you can actually use that price as the basis for the sale to the related party, then generally that's always preferred to looking at, you know, for instance, third-party companies' profitability and comparing it. Which would be maybe a little bit more inferior of a method and not as exact of a science. But, you know, those kinds of situations are hard to meet because, you know, there may be different volumes, there may be different countries involved, and there may be different, you know, business strategies. And there may be a market penetration strategy they're taking where they're selling at a lower price to gain market share, but that's different than the circumstances associated with the transaction you're trying to price. So all this stuff has to be taken into consideration. And, you know, profit split, like I said, is generally used when both sides are creating valuable intangibles. So there are certain like instances where you'd want to select a particular method or another, but it all comes down to what is happening between the two entities you're looking at and what data do you have available to you. So.
Perfect, thank you, Randall. Alex, would you like to walk us through the specific transactions that were discussed during the meeting?
Sure, Victor. And just a comment on what Randall just explained about, you know, the controversy about the profit split method. I think we can stay on that. That's okay. I recall, and I'm going to show my age now, that when Brazil introduced the transfer pricing rules in 1997, that the discussions with the tax authorities, when the industry asked why not the comparability, as Randall explained, I recall that the comment was, we want to do something that will not generate controversy, and over time we will adjust the rules. So the fixed margins, they were aimed at avoiding that level of complexity. Of course, I think the country waited too long to adjust. That was an interesting part of my recollection, because clearly the rules were inspired in the arm's length principle. I recall that Brazil sent agents to be trained in the United States with the IRS, but the decision was to do something that could be a little more clear-cut with the fixed margins to avoid that level of controversy. But now, I think it's important to hear from Randall that the controversy will not go away. I think with the new model will increase. And it's going to be interesting to see in the bill that the government proposes to overhaul the system, whether they're going to be also some settlement procedure between taxpayers and the tax authorities. Because Randall and Shee, correct if I'm wrong, but settlement procedures in transfer pricing, it is something that's widely used, right? When there is a controversy to reach a little more certainty, right?
Yeah, I mean, you hit it right on the head, Alex. I mean, it's not just going to be about passing this law and then seeing, it's also going to be how the government chooses to administer it as well, because this is obviously a totally different skill set than they probably have within the administration at the moment. And it will require training and development and around these concepts and to be able to administer the arm's length principle in this way. And it, you know, to be determined how that comes out, whether, you know, certain countries around the world can be very aggressive when it comes to this, given the subjectivity associated with it, and others are a bit more passive. And so it from a dispute resolution standpoint, most countries have both the domestic dispute resolution method, which would go through some sort of, you know, appeals or other process that you'd get before you get to litigation, but also an international version, which would be based under the tax treaties, which are designed to reduce double taxation. And anytime you have adjustment to a transfer price upward in one country, it's creating double taxation because you've essentially already paid income on that in the other country on the transaction as a result of, you know, paying tax on profits. In one country, it's going to be revenue, and one country, it's going to be a cost. And so if you adjust one of those, then essentially you've created double taxation. And that's what the treaties are designed to resolve. And most treaties I've seen have an article that will involve both countries getting together to actually resolve and discuss on the taxpayers' behalf to resolve the issue. And so that'll be a whole division that Brazil will have to set up, is a mutual agreement procedure division to resolve disputes. It's going to be fascinating to see how this all plays out. So certainly,
yes. And before I go through this slide, I just would like to remind the audience that there is a Q&A box at the bottom of the screen. If you want to send us questions, we'll try to address them at the end of the presentation. But going to the special considerations, and I think it would be important to spend some time here, because when we look at each one of the type of transactions or intangibles that we have here, the current framework is very different from what we're going to see based on the OECD framework. So starting with intangibles, the rules in Brazil rely on regulations that came during the 1950s. The royalties, need to be registered with the trademark office. You have limitations. The banks need to have a certificate from the INPI to allow the remittance. So the concept changes significantly, particularly when you think about valuation methods and royalties. And I would like Shee, Boon, and Randall to comment a little more how it works when we talk about intangibles in the OECD framework.
Yeah, so intangibles transactions, as I'm sure all of you know, it could have a number of different forms within a multinational group. You could have a licensing transaction. You could have a sale of IP or IP rights within a multinational group. You could have cost sharing arrangements, IP contributions. There's all different ways that IP could interact within a multinational group, and it's a matter of pricing that, again, consistent with the arm's length principle, using the data that you have available. And sometimes that's one of the other methods, which we didn't talk about in the last slide, which would be more like a valuation, which is a whole separate set of of methods altogether, which we didn't talk about, using discounted cash flow or various other methods starting with the data that you have. But again, it comes down to, what is that IP? Is it a brand? Is it technology? Is it product design and formulation? Is it know-how? So there's a lot to be done. And sometimes, when we work with clients on articulating what that IP is, where it's owned in the group, where it's developed, all these things have to be answered as part of our fact finding. Especially when we're starting sort of fresh, like, a lot of companies, I think, involved in Brazil will have to be, they'll really need to get their arms around, where is the IP owned? Where is it developed? Who's contributing to it? What is it? How do we determine what it is? And that's an exercise I think a lot of companies will need to think about. And actually, it's probably something companies should start thinking about sooner than later, before the arm's length principle comes around, because it may be something you can be doing in the interim as well. So,
right. Yeah, the next aspect I think we touch upon when we talk about the risks, functions, and assets that the business carries out in Brazil. So when we think about manufacturing, sales, and distribution companies, the current model does not make a distinction among them. But in the OECD, it is something, as you already point out, Randall, that has to be analyzing the fact-finding part of the work, right?
Yeah, it definitely. I mean, characterizing the manufacturer, maybe they're just a contract manufacturer where they don't have any of their own designs for the product, but actually they're just, taking designs from someone else in the group and producing that and sending it off. That's a totally different profile of a manufacturer versus someone that a company that has their own engineering department, their own R&D department, designs their own product, has their own patents, everything. So that's the distinction we're looking at versus, the broad-based fixed margin that you were talking about. And the same for sales and distribution. If they're, on the ground creating creating their own marketing intangibles and have an entire marketing department, or are they really just getting that all their marketing material and concept and branding from somewhere else, and their job is really just to execute on the sales? That's a totally different profile, whether you have that or not. And so, and that also depends, you know, when you look at comparables, we have to figure out, are the comparables doing that or not? And, you know, generally, like we said, the more functions, assets, and risks you have, the higher profitability the company should generally have. So, and that's usually reflected at arm's length.
Yeah, and that's a good segue when we talk about services, because the current rules, for example, if a Brazilian entity is providing services to a related party abroad, you could use the cap method, which would be a cost plus 15%, but that doesn't take into account the type of assets, functions, and risks that the entity is actually producing. Because if it is more like a routine type of service without any intangibles being created, probably cost plus 15 would be too high. But if it is a high value service, then cost plus 15 perhaps could be too low, depending how the comparability pans out, right?
Yeah, I think Alex, let me jump in here. I think in this one, sort of for services, generally under OECD guidelines, there are two types of issues here. One is sort of the charging of the service itself, whether you have any benefit being conveyed by this service. And generally, there tend to be a lot of disputes in that space. There are circumstances where, in fact, when you look at the function and assets and risk and look at the fact pattern, that maybe it's not actually a service. There is no additional sort of benefit being conveyed as part of the transaction. And that may not be a transaction that can be chargeable. And so there is this threshold question, first of all. And then once you get past that threshold question, it's a question of how much can you charge. And there you have a different kind of methodology. The first part is to say, well, actually, you're just doing an agency function. You're passing on sort of third-party costs. And in those cases, generally, you cannot apply any markup. There are sort of low value add types of services where you can get a routine activities being performed, and the markup under OECD guidelines at the moment is cost plus 5%, right? And then if you want to sort of do something a little bit more, then it requires to carry out a benchmarking exercise to look at comparables and trying to justify what is the right sort of level of markup you can apply in this context, right? So when you look at all that and then you compare with cost plus 15, you think, well, actually, maybe it's more certain to do cost plus 15. But you know, if there is additional benefits to kind of carry out and in essence categorize these intra-group services in these different buckets, it is what OECD guidelines actually would require you to do. And I think the other aspect also is in relation to services is sometimes linked to actually your distribution, right? Because I think a lot of the time you might carry out certain activities because you are actually a distributor. But some countries are looking at that function of a distributor, like marketing activities. How much marketing activities is a typical distributor expected to do, right? And in that context, sometimes, you know, in certain situations, as well as performing a distribution activity, some entities actually may be required to be compensated with an additional sort of service return because it's doing the activity in a slightly more extensive fashion compared with other distributors, right? And that can become also a little bit of a tricky issue in practice, where tax authorities may see what I would say kind of a hidden service distribution, when in fact, you know, you might see only just a distributor. There may be some kind of additional transactions that tax authorities may see, and that require a little bit of a special consideration. when it comes to services.
Yeah, there's generally a lot of controversy around that issue Boon just talked about, but also just in general with respect to services, for the first reason that he mentioned around benefit, this is why fact finding on these transactions is so important with the business, because you will need to gather evidence that not only that the service occurred, but that actually the local entity which is going to deduct that service benefited from those activities. So if you have a central HR group somewhere, finance or whatever, and you just charge those out blindly without really documenting that the local company is actually benefiting with evidence, benefiting from those services, it's likely the local tax authority will just deny the deduction on that on the basis that they didn't meet the benefit test, or even other domestic deductibility rules. But there's a ton of controversy in this space. So,
right. Yeah, one other concept that is quite new and should be addressed in the new proposal are cost contribution arrangements, both on development and also services. Perhaps you guys could comment a little more what that is and what that means to companies.
Yep. I'll start, Shee, you can jump in. So development CCAs would be when more than one party is contributing to the development of intangible property. And so, you might share in the risks associated with developing that particular intangible property. And this is something you see quite often in the real world too, to share some risks associated with it, because when you're developing intangibles and incurring a lot of cost up front on R&D or marketing or whatever the costs are, there's risk that won't materialize, the intangibles won't generate value for the company. And so a lot of times it just makes sense to share that. Services is a way of, if there's a sort of central entity providing services on behalf of maybe a region or the entire group, it's a matter of ensuring that those costs get apportioned out to all those group entities in a way that is reflective of the benefit and the arm's length principle. And that could involve having costs allocated out based on allocation keys, which are reflective of the benefit. So for instance, HR costs being charged out based on headcount in every place is a lot of times what is used. If you can make the link between the key you're using, such as headcount, and actually how they're benefiting, then the more headcount you have, the more costs you're going to incur from the central entity. So, two different types of CCAs. A lot of companies use both of these, to be honest.
Great, thank you.
Well, I've seen CCA, I think, being used in this sort of in the transfer pricing arrangement. Typically is, it depends on a little bit the fact pattern of each company. So, for example, you might have a fairly decentralized sort of model where, let's say, activities are carried out regionally, when you might develop sort of know-how or brand on a regional basis. Then you could potentially think about using cost contribution arrangement to support that, so that entities kind of contribute the cost, and then they will own these intangibles within the group in their own right, and be able to exploit the result of that without then arranging licensing agreements or specific service agreements that would then need to be paid for, right? Because I think it could be an interesting instrument in the context of Brazilian rules, because I know Brazil has a lot of indirect taxes, for example, right? So where you have maybe a centralized model with intangibles being owned in Brazil, let's say, then going forward, if you're looking at owning intangibles in Brazil, but these activities that contribute to the creation of this intangible, let's say you might say them as services, are being done outside of Brazil, then you might potentially, under arm's length principle, having to put in a service agreement, right? Because the intangible owner is contracting with a service provider to provide services for maintaining or supporting the intangibles. And this service agreement can potentially carry a lot of indirect tax costs to it.
Yeah, that's a very good point that you raise about the indirect taxes, because that could be, a threat to the unwary in Brazil, since there are significant implications here. And we are running out of time on this topic, but I just want to close on this before we move to the next one, talking quickly about reorganization, because that's an important topic that currently, if there is a transfer of shares between related parties in Brazil and abroad, either way, the rules apply, but there is no actual method to capture those transactions. So it becomes a gray area. And under the accounting principles, the intragroup transfer should not result in a step up of the assets. But we know that under the OECD guideline, those transactions are also captured by the rules and should be done at fair market value. Am I correct, Randall and Shee?
Yeah, absolutely. I mean, typical ones that you see are, movements of IP across borders, or where actually you're converting an entity from more like a fully fledged manufacturing or distribution operation to more routine, which involves reducing the profit of that entity substantially. There can be a lot of controversy around that because it wasn't that company's decision. So there can be what we call exit charges associated with that, that a local tax authority can impose based on that reorganization. So,
right. So let's move to the next topic, Victor.
Alex, just real brief on the financial transactions there before we go. I mean, this is becoming more and more important as interest rates rise worldwide. I mean, all sorts of financial transactions also have to happen at arm's length. And so that generally means the interest rate that you have between related parties needs to be consistent with third parties. And there's a lot of data out there on that, but this is one that I think companies spend a lot of time on for rightly reasons. It's becoming more controversial as well. So.
Very good point. Thank you.
In that regard, it's how countries are so different as well, because if you compare interest rates in Brazil to the US, you're going to find enormous differences. But let's move on. So TP documentation. We are currently aware of the country-by-country reporting, which is in effect in Brazil. Much of the multinational companies, they have their parent entity doing all the reporting, but some Brazilian-based multinationals are doing the reporting. But master file and local file, these are going to be new for most of the companies, which are not required by the parent to be preparing the files. And if you can just walk us through a little bit about what the TP documentation will look like under the new rules.
Yeah, I'll just take this one briefly. Master file is generally supposed to give the broader picture of the company and the end-to-end supply chain globally, and what happens where. And there's, it's a pretty prescriptive, what the OECD has put out, which a lot of companies have adopted into their domestic law for compliance requirements. The local file should only cover the transactions that are relevant to the entity you're providing the compliance documentation for. And so it should have, on the right there, you see the 4 different types of analysis that you typically see in a TP documentation report. Analysis of the industry, so just to understand the value drivers in the industry or the company in particular. And then functional analysis is really what is happening in each entity. So what are the functions, assets, and risks of each party involved, which forms such an important part of comparability analysis. And then the economic analysis is really where you're looking at comparable data and applying that to the transaction. In a nutshell, those are generally the 4 areas that you'd find in the reports. So.
Thank you, Randall. I think this is something that the taxpayers are going to have to deal with that when the time comes. And then we have our the final topic about tax certainty, which is Brazilian tax authorities are going to be authorized to enter into APAs. We already have the MAP mechanism, although it's not real. It's rarely used because of uncertainty about we're not that familiar, but we have a fair share of MAP cases going on. But if you can just talk about what happens in an APA, that will be beneficial for the audience as well.
So in an APA, I'll talk about the bilateral context. That's really using the treaty in the MAP article as a way for the company to get certainty on their transfer pricing going forward on a go-forward basis. So you're basically getting both governments, tax administrations to agree on the transfer pricing on a go-forward basis. So typically you'd apply with an application in each country, which is not all that different than the local files that we talked about before. And then the countries will ask questions of the taxpayer, and then eventually they get together and discuss and agree what the transfer pricing should look like. And the taxpayer gets at the end of the day, an agreement based on the treaty that there will be no double taxation and that their transfer pricing will be agreed going forward. Usually it's five years or so, and then you can renew it going forward. But it's typically within the government, the same group that would handle the MAP cases as well. So.
Thank you, Randall. So I'll open up the floor for you guys to talk a little bit about a proposed action plan. What do you think is going to be important for the companies to take into account and to start planning around so they are ready when the time comes, probably next year or the year after?
Sure, I'll take this, and Boon, just jump in with as you see fit. I mean, obviously reviewing your transactions in and out as to, some companies are looking at sort of a sensitivity analysis or impact analysis of this. If they do implement the arm's length principle, what does that mean financially? What do you have to do from a compliance standpoint? What does that mean for our transactions and our pricing that we're using today? And then I guess thinking about how that would be implemented in the systems, what impact that has on other things such as customs and VAT, which we only have an hour here, but we could probably spend a whole hour on that alone. So, and then whether you want to you see enough risk associated with each side to think about an APA, or be prepared to use MAP to relieve double taxation if you do get an assessment from the Brazil tax authorities or even the authorities on the other side. And so, I mean, the main thing I think I would be thinking about is what is the impact of this on the transactions as they lay today? And I'd really be thinking about intangible property and with respect to Brazil, and where that is considered today and how that's going to look after the arm's length principle. Because typically IP, as we call it, would have a lot of profit associated and attached to it. So it can be quite significant. And so I think you really want to think about what the Brazil rights mean, where those are owned, who develops them, and so forth. So.
Randall, when I was at the OECD, there's a favorite phrase when we come to describe the OECD transfer pricing guidelines, and it's more of an art rather than a science, right? Yeah. And so for me, it's just welcome to this artistic world of OECD transfer pricing guidelines, essentially. And here, to me, I think the starting point is always that you have to understand your global value chain, right? So where value is created, and the remuneration model that you come up with in this TP needs to follow that value creation aspect to it. So if you have a good understanding of it and the model follows it, and then you document it based on that, and make sure that you put in place a documentation that has a good defense angle as well, that's going to be critical to sort of being able to put some ring fence around your controversy risk. I think that's really the gist of what I would say is needed.
That's very good. Shee, Boon, Randall, Laura, Victor. I think we reached the mark here. I want to thank you all for your time and insights and commentaries here. As we discussed, this was meant to be our preliminary reactions. We probably could be here another 3 hours just talking about all the other ramifications. But I think the key message for the tax officers who are in the audience is that you could start preparing for the changes, doing this analysis, as Randall said, there could be systems implications, and taking what Shee mentioned about reviewing your value creation and remuneration to determine those steps. So I want to thank everybody for joining here and wish you all a very good weekend until the next event that we organize. Okay? Take care.
Thanks, everyone.
Bye-bye, guys. Thank you.
Thank you.
Thank you.
Thanks, everyone.